Yes, 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 yes. Hey guys, welcome back to my channel, Gerald Peters. I'm the author of the book, You Don't Have to Die Broke. Like a dummy, I didn't bring a copy. That book is free as always. I give it out free, no catch, no hook. It's just completely free. Today, and I'm also the author of a book called The Money Flow and a podcast called The Science of Getting Rich. Today, let's talk about what did we learn in this recent stock market sell-off. Now, I hope you were watching. We've recently had the coronavirus. This is basically, if you've ever heard the term black swan event, that's what this was. Now, I know some of you guys may push back and say that's not what. Listen, sudden price shock comes out of nowhere. No one knew this was going to happen. Now, you're going to have gurus and people who, I told you, they didn't know a coronavirus was going to strike. Now, there's always something, but it does show you how fragile the economy is and how easily markets can be rattled. That sets up an opportunity for you if you're smart. Now, in my book, You Don't Have to Die Broke, Chapter 10, I talk about this strategy called the dogs of the Dow. This is when you want to be all over that strategy. That's you buying quality American companies that pay dividends, that allow you to compound your wealth, and buying them at discount. That's what I like to do. But we'll get to that. But let's talk about what did we learn in this stock market sell-off. Well, we learned a couple things you should have learned. One, trading on margin is dangerous. Yes, margin can make you a lot of money. Margin could make you rich. I met a kid once recently who put $50,000. He only had 20 grand in the account. They give you a margin. He put it all into Shopify, rode it all the way up, made like $200,000. That can happen. Margin can make you money, but when stocks go down, when you get caught on the wrong side, it hurts times 10 or 5 or whatever your margin. Dangerous, dangerous, dangerous. Keep the margin under control unless you're a professional who knows what you're doing. So we learned that if you were on margin, don't cry about it. Just lick your wounds, realize what you did wrong, and get back up on the horse. I've done it more times than I am comfortable even admitting to you how stupid I've been. I've done everything you can possibly do wrong. And that's why I wrote my book, You Don't Have to Die Broke, because I just wanted to share the things that I learned. One thing you're going to learn about me is I like to keep it simple and easy. I believe in a couple things. I believe in dividends. I believe in rent collection, right? So these are the foundations of my business. Now I run a very simple strategy. I own a bunch of rental properties, physical assets. I take the profits from the physical assets and push them into digital assets, such as stocks, dividend stocks. And so I have a portfolio of about 15 houses, not that big a deal, right? And about 44 or 42 stocks. Now, all of these produce about $150,000 to $170,000 a year in cash flow. I started that with one house and one stock. And I've just continued to push my intent into the universe day after day, week after week, month after month, year after year, of just this basic strategy that I call the money flow, of just buying quality companies and buying just normal, simple, everyday working class houses, small, normal houses. I like 2, 1, 3, 2 bedroom houses, like just simple, working class neighborhoods. Nothing fancy. I'm not trying to flip. I'm not trying to buy something with no money down. I'm not trying to arbitrage or take out equity loans or borrow against my retirement. I'm not trying to do any of that dumb shit. I just try to have a solid credit score, 700 plus. I try to save up money, enough money to put 20% down, and then I go in and buy it. Nothing fancy, nothing complicated. You don't need a course. You don't need anything. Good credit and money. That's it. That's my strategy. And I try to accumulate one house a year. I then push the profits from that one house into stocks. Now, what I like to do is I like to first attack my IRA. Why? Tax shelter. I don't want Uncle Sam getting his money on my dividends. So I get a tax break for owning the houses. You get to depreciate the home, right? So real estate makes money a couple different ways. 1, appreciation. 2, depreciation. Cash flow, loan pay down, right? So this basically runs cash or tax free. I push that into tax sheltered accounts like IRAs, SEP IRAs, and I max it out. So if the government allows me to have $6,000, the wife can have $7,000, that's $13,000 tax deduction paid for by my renters. Thank you very much. Oh, now I'm self-employed, so I go to the SEP IRA. I can put up to 25% of my income, where it's $52,000, shelter even more. So as I make this tax-free money, I can push the profits into tax-free instruments, so that all of this wealth begins to grow accumulatively tax-free. Make sense? That's how I've done that. Now, that scenario isn't you retiring in 2 years or any of that. This is investing. This is not making money or income. Investing, you don't invest full time, right? People get this a little like, oh, I want to go full-time real estate. That's not what I do. I'm an investor. So I have to find ways to make money. But this video is not about that. I would just caution you if your goal is to, quote, go full-time in real estate. That's never been my desire. That is the desire of a lot of people that sell courses, and I don't think that's how you should be looking at real estate. I think you should keep it a lot simpler than that. But what did we learn? One is margin can be bad. What else did we learn? You should have bonds. Bonds. This is not sexy. A lot of people don't even know what this means. So if you're running a self-directed IRA or stock portfolio, it looks like this, the TLT. TLT, it's a 20-year government treasury bond. Don't let this shit confuse you. Some of you guys out there, your roofers, your plumbers, your truck drivers, your blue collar like me, look, my shirt's got paint stains. I'm painting a house today. Don't let this shit confuse you. If you have to, email me, DM me, text me, call me, whatever. This is not complicated. This is debt sold by the U.S. government. It's called a bond, just like a stock, a savings bond. This is a bond that the government uses to fund the damn country. And we're loaded in debt, and so you can always buy these. It's going to pay about a 2% dividend yield. So they're going to pay you to own this paper. When stocks go down, bonds go up. Bonds go up. Now, I know some of you are going to get into the mental masturbation because you've been reading a lot. You're going to get into the fiat debt currency coming, crash bubble, and the gold, and we're going to need our guns and our gold and our... All that aside, work with me. Pretend like the U.S. economy doesn't crash. We don't go into zombie land, and we all live to be really old people, okay? I'm working on that premise. I'm having faith we don't have a global disaster, okay? You need bonds in your portfolio. The bonds went straight up. If you look at a chart of the TLT, it looks like this, while the market chart looks like that. And so this is why you want to have a little bit of a weighting in bonds. And so, I don't think you need any more than 20%, maybe 10% when you're younger. You could have more. Now, what would I do as the bonds went up? Let me tell you what I did as stocks go down. I started selling these off. I'd sell a little here, sell a little here, sell a little here, sell a little. Why? So I could buy stocks here, buy stocks here, buy stocks here. I'm not going to get the timing right. I'm just going to take from an asset that went up and add to an asset that went down. Simple, right? It's not that complicated. At some point, I'm going to stop selling because I need to maintain a weighting in bonds. So one way is, let's say you 20% of your account. As the value of this goes up, it becomes larger than 20% of your account, right? And so you just sell some off to maintain that weighting and push that money into stocks. And then when the stocks recover and it goes the other way, the bonds are going to go down, right? And then guess what? You might need to sell some stocks to put some more back into bonds. And this is called portfolio balancing. Not complicated. Don't let this complicate it. Super simple. Now you don't even need to do that at first. I'm just right now, it's lessons we've learned. You should have had bonds. 1, TLT. 2, let's talk about gold. Nothing wrong with having some gold. For me, 5% is plenty. I'd rather have 5% gold. Some people say 10%. I'd rather have 5% gold, 5% cash. I don't want to be a hypocrite. I do not sit on cash. I wish I could. I'm just not that damn disciplined. If you give me cash, I'm going to invest it in stocks. I can't help myself. I'm always finding deals. I love dividends. Love dividends. So if you give me $10,000, I'm going to invest it. Can't help it, can't keep it. I'm not good with money. I won't blow it. I won't spend it on dumb shit. I'm not buying a bass boat. I'm not buying some fucking jet skis. I'm not buying another. I like those things, But if you just give me $10,000, more than likely when you wake up tomorrow, I will have invested it all, right now, probably in Delta Airlines. So we learned gold, we learned TLT bonds, and we learned about cash. So if this sell-off didn't teach you anything, is this what it should have taught you? If you'd have had some bonds, if you'd have had some gold, and if you'd had some cash, you would be loving this sell-off because you'd be selling some bonds, selling some gold, taking that cash, and then you'd be buying things like what? Delta Airlines. Warren Buffett owns this stock. DAL. Nice dividend, good company. What else could you have been buying? Starbucks, my man. Starbucks. Could have been buying Starbucks. Huge exposure to China. Stocks getting crushed. Quality American company right there. What else could you be looking at investing in? CCL, Carnival Cruise, maybe Wynn, right? All these stocks that are getting hammered right now, just hammered, thrown out with the baby in the bathwater, you could be buying those stocks because you have a 1 to 2 year window. A little bit speculative, but here's what I like about Starbucks: pays a dividend, Delta pays a dividend, Wynn pays a dividend, CLC pays a dividend. Wouldn't surprise me if they end up cutting their dividend. I could be wrong, maybe they'll defend it. What else has been hit hard in this sell-off? Exxon, Chevron. Now Chevron, I like Exxon, but let's talk about Chevron for a second. Ticker symbol CVX. Chevron just said they're going to try to return $5 to $8 billion over the next 5 years, 5 to 7 years I think it was, to shareholders in the form of buybacks, meaning they're going to buy the stock in the open market to keep the price up, and dividends raises. Man, you got to like when you're invested in a company that loves you. They love you. They want to give your money back to you. I like that. I've been buying shares of Chevron into this sell-off. Now, if you have my book, You Don't Have to Die Broke, Chapter 10 is entitled Dog Power. Chapter 10. This book is free, so if you haven't read it, it's because I don't know why. Chapter 10 is called Dog Power. It's a simple strategy to buy 10 stocks. And every year you rebalance it and then you buy 10. And then you rebalance it at the end of the year and you buy 10. Super simple, one of the easiest ways. You don't need a manager. It's got a 80-year track record or 50-year track record, whatever it is. It pays dividends, it compounds, and it grows, and it beats the market most years. Didn't beat last year though, but it beats most years. Now I don't follow it completely religiously like the system, but I do follow the basic idea that it's the 10 worst performing Dow stocks from the last year. Why? Because the ones that did the worst last year tend to do the best the following year, because as people go looking for value. Now, to even get into the Dow, the Dow Jones Industrial is an average. It's an index devised of 30 companies. So they've done all the sorting and selecting and filtering for you. They've found companies that meet a certain criteria of quality, of size, of transparency, that pay dividends, and they put them into the index. Stuff like Home Depot, Apple, things like that, right? Like quality, Walgreens, Procter & Gamble, like all these companies that you know the name of. AT&T was in there once, Verizon, and sometimes they pull one out. They pull GE out, they pull out AT&T, they put in something else, right? So they kind of do the sort and selecting for us, so we can just buy them on sale. You don't even know how to know to read charts. These are the stocks that are on sale. They pay dividends, so every investment you make pays you a little bit of money back in the form of a drip. You get a little drip of a dividend. And if you're smart, you're going to drip that. You're going to reinvest that back into the stock market. So every week, every month, every year, I put money into this strategy. Again, this chapter 10 of my book, you could also go and just Google dogsofthedow.com, thedogsofthedow.com, I think it is. Or maybe it's just dogs. Super simple strategy. When you get this is called a black swan, like I said, like nobody knew it was coming. Boom, it happens. Oh, what do we do now? Well, if we owned bonds, if we had gold, if we had a little cash, and we didn't have a lot of margin, this is what you call a buying opportunity. And the way roofers, plumbers, truck drivers, and just average fucking Joes like me and you get rich is taking our money and putting it in the market when the sophisticated fund managers, little bitches that are selling right now, when those guys are selling, all the guys with the Harvard degrees and all the real smart people, who do you think's selling? It's computer people, people who design code, all these guys that are way smarter than you. They're just selling. As they sell it, it opens up an opportunity for the simple-minded folks like me to buy. And that's what I do. Step in, start buying. So let's recap what we learned. One, this is a chance to buy quality companies on sale. It's also a time to do a little speculating. What are some ideas? I'm going to leave you with a couple ideas right now. Uber, Lyft, hit hard. Who wants to get in a car with a guy that has Corona? Not me. Stocks are hit hard. I got a $62 target on Lyft. I am not a stock evangelist. I'm not a financial advisor. You should not listen to anybody on the internet that you don't know to buy stocks. I think Lyft is going to $62 and Lyft and Uber is going well north of $50. This sell-off has given me an opportunity to get thousands of dollars. I personally put about $10,000 in 5 in Lyft and 5 in Uber. Exxon is another one, Delta. We already went through a list of these. These are the kind of things that I'm buying right now. I might be wrong for the next 6 months. That's okay. I got a huge time window. So what we learned, so these are ideas, the type of ideas. Now, not some unknown penny stock that nobody's ever heard of that's down the road from your house. Big companies, Facebook, Starbucks, the big ones. And we learned we should have had bonds, TLT. We should have had a little gold. We know that. We should have had a little cash. We know that. But most of all, right out of chapter 1 of my free ebook, I call it The Money Flow. If your money was set up right, this would be nothing but an opportunity for you. This is how you make your money. You should have a side hustle or a side job or a business, or you work overtime. Somehow you work more than 5 days a week. You should be working more than 5 days a week. This is your necessities bucket. This is where your bills and your debts are. You should get debt free. This should be your first goal, not investing. Once you're debt free, only then should you save money. Savings is not investing, and investing is way over here. Long before you get to investing, like if you're investing and you have debt, you're a dipshit. You should get rid, yeah, I said that right, dipshit. You should get rid of your debts. College loans suck. Car payments are for the poor and the middle class. Get rid of this shit, or the rich. See, the car payment is the payday loan of the middle class, as Dave Ramsey says, and I agree with him. Now, if you're rich, own a big-ass business, keep your comment to yourself. I ain't talking to you. I'm talking to blue-collar people, average people. My book is about how ordinary people become extraordinarily wealthy. Just normal fucking people. And you don't do that by having car payments, student loans, and credit card debt, right? If you're rich and you want to lease a car, have fun. But if you're an average working class person, no car payments, no credit cards, no student loans, you need to only have bills, live frugal, load up the savings. You need 6 months to a year minimum, 3 months minimum before you begin investing. 3 months of savings before you begin investing. Now, some of you are going to be like, well, I'm just putting in 100. You're doing it wrong. Listen to me. If you do what I show you in my free ebook, if you get this shit right, and you don't half-ass do it, because here's what most of you are doing. Listen. This is what most of you are doing right now. A little savings, a little investing, a little college fund, a little debt paying down, and what you have is a whole lot of fucking little. That's it. That's what you have, a whole lot of little. And so what I'm advocating is that you put all of your energy from your job and your business to eliminate debt, to finally break free of the shackles that have bound you. You think slavery's over? It ain't over. It ain't over. All kinds of you guys are working jobs you hate. You can't do what you want. You can't follow your passions because of all these stupid bills. So let's get rid of the debt. Now we can do some serious savings where you have some real money set aside. Physical cash set aside. Physical. No banks can take it. The government can't take it. Ex-wives can't take it. Nobody can take it. It's in actual cash. Locked away. Then we start investing. Now when we invest, we get to keep all that money. And this is how you get rich. You structure this. And that's what you should have learned in the market sell-off.